Real estate is about freedom, choice freedom, time freedom, and money freedom, and the impact you can make with that freedom. But it doesn't come without cost. Your freedom takes work. That's why Neil Timmins brings together the tools you need to build your real estate legacy, from tips and tricks to interviews with industry titans. It's all here in one place. Real Grit. Let's get to it.
Everybody, welcome to Real Grit. I got Joe Viery here. Now, let me tell you a little about Joe, his background. Over 15 years in the real estate industry, most of which has been spent in the cost seg side of the industry. And for those who do not know, we're going to get a deep dive in what cost seg is and how it can save you literally hundreds of thousands of dollars. So I'm excited to have him here. Joe, how are you?
I'm great. Thanks, Neil, for having me.
Yeah, man, it's good to have you here. So tell me, before we dive into cost seg, because I know you didn't start there, how about for the audience's sake, tell me, what was your entry point to this industry?
Well, I'll back up a little bit. I've always been in the entrepreneur mode. And when I got out of college, I stayed in the travel industry and I started a company which produced special interest tours. People like the San Diego Opera, actually the Milwaukee Opera, just so many places, entities all throughout the country. And I put together special interest tours. In 2000, I sold that business and I started in the financial services part of the California Association of Realtors.
Okay.
And somebody kept bugging me to learn something about something he just found out about. And I thought he wanted to sell me Amway soap. So I blew him off for about a year. And finally he was persistent.
Yeah.
And I said, okay, Mike, let's go to lunch. Tell me about this.
Yeah.
And actually it was cost segregation and tax saving strategy. I had clients who were complaining to me that they had to write checks out to the IRS. They owned real estate. I said, let's try this. And it worked. And I saved them $50,000, two different clients.
Yeah.
And then in 2007, the car went over the cliff in the California Association of Realtors. It still existed, but not the way that I knew it for those past years.
Right.
It shriveled up and almost died because nobody in California was selling real estate or acquiring real estate. Well, there were some. So basically it was very easy for me to segue. The owner of the company that I worked with to do the cost seg said, why don't you come work for me? You're great at this. And our industry is not slowing down. And he was true. I started going up and I never stopped going up in cost seg.
Wow. Okay. So, and then at some point, so you joined that company, and then at some point, did you bridge off on your own or you're still there?
Yeah, no, I segued into a couple different companies.
Yep.
And was very happy with them, but I found my own calling when I started U.S. Tax Advisors Group in about 2016. And one of the reasons why that it was a great situation is because we developed a technique where we can do accelerated depreciation, cost seg, for investors who own single family homes. I do $500 million projects. I do the big one city block in downtown San Francisco. But what's catching fire right now are the single family home investors.
Yeah, you really run the gamut on everything. It sounds like from single family all the way up. Talk to me about, well, how about this? Tell me, what is cost seg for the audience's sake, for anybody who doesn't know what that is?
Okay. Depreciation is an expense the IRS allows the owners of investment real estate. And basically what they're saying is, okay, we recognize you're using up your investment every year that you own it. And so rather than wait for years and years and years, they allow you to expense part of that, that real estate investment kind of being used up. And that's called depreciation. The easy way, the simple way, the way that most accountants today still depreciate buildings is straight line. You just divide a residential property by 27 and a half years or a commercial property by 39 years. So what does that give you? That gives you a little sliver of the depreciation expense over 27 and a half or 39 years. Although straight line is the easiest method to use, it's not correct. And I can just make the argument and explanation very simple. Anybody who is in an investment property and looks down, you have some sort of, normally it's carpet or vinyl or old linoleum. And basically I would ask them, okay, is that linoleum or carpet? Let's use carpet. Is that carpet going to last 27 and a half years? And everybody goes, heck no, I'm lucky if I get 5 years out of my carpet at that.
Right.
And so everybody understands that there are different components in the building construction that the IRS recognizes have a shorter life than 27 and a half years. So what we do as engineers is we identify those components, and the outside of the building is 15-year, the inside is 5 and 7-year. So if you combine the 15-year with the personal property,
with the 5
outside
and
of the
7.
property
Yep.
with the personal property, we accelerate the depreciation and we give you your depreciation up front instead of waiting 27 and a half years.
All right, so let's stick with carpet. Carpet doesn't last 27 and a half years. So we're going to say it lasts, for the IRS's sake, probably in a 5-year category or 7-year
is.
category. Okay.
5-year category.
5-year category. And what you do is that you accelerate that so that somebody can take that in the first year.
Correct. Now, there is another wild card here. We
Yep.
need to talk about bonus.
Yep. Bonus
Bonus
is a
is
big
something
deal.
that-
Right.
Yeah, 100% bonus just happened started in 2017.
Right.
So here's what's going to happen. We have 100% bonus, and how the rules read, 100% bonus means that if you have a property in your building with a life of 20 years or less, you can expense that completely the year that you identify it. Well, who knows what life of the building is 20 years or less? The accountant doesn't know it.
No.
The building owner doesn't know it, but that's what we do. I just identified what we do. We break out the life of short-term assets. So everything we find when we do cost segregation is expensed 100% the year you do the study. So right now we're working on extensions for 2021 taxpayers.
Yep.
And so basically everything we find, they can write off entirely, 100%. Now, in 2022, it's still 100%. So we've got one more year. And then in 23, it starts to graduate down until it phases out completely.
80, 60, 40, 20, 0, right?
But I basically have been dealing in non-bonus years most of my first 10, 15 years.
Sure.
So it doesn't phase me.
No.
I don't really use it as a sales tool, but it is nice to get the 100% bonus.
Yeah.
You know, but when it goes away, is it going to like end my industry? Oh, heck no.
No.
I've been dealing with non-bonus for so long that it just means, and what's it mean simply is that instead of getting that big chunk up front, now you're going to get most of it up front, but then you're going to have trails for 5 years.
Got it. Yeah. So you're able to put everything under 20 years into one lump category, and instead, non-bonus would this mean, which really is 5 years from now, actually, right? Because we're going to get a piece of bonus for 5 years. So,
and who knows what's going to happen? Congress, IRS, I shouldn't say IRS, it's Congress. Congress could extend the bonus.
Right.
I don't know. I don't care.
Right. Yeah. Yeah, exactly. Well, that was a piece Trump put in place, a little hat tip to probably to the real estate friends. Right. And you may see that as the powers that be wax and wane. So who knows, they'll end up back in office and what they end up doing.
Well, hey, real estate is a big component of our economy.
No doubt.
So the IRS to mess with depreciation, good luck. I mean, they did an incredible thing with the 100% bonus, but if they try to take away depreciation, I don't see it, because the real estate industry is massive.
Well, I'm with you. As soon as you approach taking away depreciation, then you're into publicly traded companies. And then the question becomes, what next? Equipment? Are you kidding me? There's publicly traded companies. I'm with you. They're not going to allow depreciation of any kind to go away.
I agree.
Yeah. Yeah. So, I mean, you compartmentalize easily. I mean, you just take the components, break it down, and people get significant depreciation. So talk to me about what that does. And I guess, or maybe give me a case study roughly on, let's say it's a $3 million building. What does that end up being? And I know it varies from asset type to asset type, right? Offices are not the same as industrial, not the same as self-storage, not the same as mobile home parks, to name a few. And then what does it end up being? Really, for an investor level at the highest tax bracket, what are they not paying?
Exactly. So I do have some of the work I've done for you, on my screen, but I don't know if I need to go there, because we did really, really, really well. And I like to estimate really, really, really conservatively, just so that, everybody's on the same page. And if
you want to make sure you got to manage expectations to make sure you can deliver on what you say.
Exactly.
Yeah.
So bottom line is, if you had a $3 million building, and this is important, we, meaning U.S. Tax Advisors Group, we're not land appraisers. So we don't go down that road. We
Yep.
have you do the valuation, the allocation of land. So if you bought a building for 3 million, then there's two ways we could look at it. We could look at it that you bought a building for 3.6 million and you decided 600,000 was land,
Right.
or we could use your 3 million and we could just take 20%. I'm just using an example to get it down to 2,400,000 for the building basis.
Yeah.
So what I've done is I've just taken the building up.
Let me interject there. So you take the land off, but I'm not a land evaluator. I'm not a land appraiser. I don't know what that is, but oftentimes who is the actual appraiser? And oftentimes when one's buying an asset, the land value is broken out in that, or the tax assessor certainly has broken it out. It becomes relatively easy for somebody to ascertain in my mind, an appropriate amount of value of that overall property to allocate it towards land.
Well, you've hit the nail on the head. It's really not that difficult.
Right.
And this is the job most accountants take, although they're not land appraisers either. So
Nope.
go figure. But, I don't get involved in that argument, that
Right.
discussion. But bottom line is county tax assessor, the IRS loves. However, I've seen them be crazy wrong, like, 40% allocation for land when I know it should be like in the 20s, because I've got the comps around the area and I know what other assessing for the land.
We just bought one that was 80%. Actually, you did the work on it. We just bought one that was 80% land allocation, 20% building allocation, which is insanity. I mean, it's not close. You would think if it's on the corner of Main and Main, all right, but that was not the case with this asset. And to the point where we argued the taxes, and the assessor now has it slated in their system to invert that. He's going, even the assessor said, Neil, this is totally wrong.
Yeah. And so be careful. I mean, but if here's what the rule of thumb, except for on the beach in Miami or in Malibu or in downtown New York or Chicago, around the country, if you take about 20%, you'll be in the ballpark.
Yeah.
And if the county tax assessor is 20% or less, just use that number and call it a day.
Yep.
If they're crazy, like 80% like you, Neil, then you've got it, because what the tax assessor does is one thing, depreciation, land allocation is another.
Totally different.
But they're related. But bottom line is I would just do another approach. And that is what I just mentioned. I would just do comps of 5 similar buildings in the neighborhood and just divide by 5 and come up with an average. And your average, for the 80% property is not going to be 80%. It's going to be more in line with probably about 20%.
Yeah. Perfect. All right. So on our $3 million example, you're down to 2.4.
Right.
With a building basis.
Yes. And for an office building, I will tell you from experience that I would estimate an office building at about 26% accelerated, which will mean I will give the owner of that building a tax deduction of $624,000, all in the year that they applied the cost segregation study.
$624,000.
Yeah. Now, don't confuse that write-off with money saved out of your pocket. I don't want people thinking, oh, I can do this and save 624.
Nope,
no,
correct.
That's the actual write-off. The actual cash in your pocket is a multiple of your tax rate.
Yeah, whatever.
And I don't normally ask.
Yeah, whatever tax rate you happen to be in.
Whatever
but in this example, $624,000. Somebody make up a number. Somebody makes $1 million, and then you've provided them depreciation in year one of $624,000. So it's literally your top line income goes from $1 million less 624.
There you go. Perfect example. You said it better than me. Thanks, Neil.
And that's where you're at. And that has tremendous impact. So oftentimes, you're analyzing what's my down payment? What's this look like from a return standpoint? You're bringing this into your calculations. And either for some folks, if the decision is buy an asset or don't, you're either going to pay the government in significant amount of taxes, or you're going to buy an asset and a tremendous amount of your downstroke comes from the taxes you would have paid the government.
Right.
Yeah.
Well put. Yeah. Now there's something else. There's a couple wrinkles. There always are wrinkles. You're dealing with Congress, and there's always weird, wacky stuff. But one of the wrinkles is that I want to call everyone's attention to the fact that whenever you buy a value add property and you need to go in there and you need to rip stuff out and throw it away. Let's say it's a multifamily, and everybody knows what you do when you buy a multifamily that's value add.
Right.
You go in there and you replace the flooring. You replace the cabinets, or if nothing else, the countertops. You probably update the bathrooms, and you can do all kinds of different work. You throw out the window coverings and put new window coverings on.
Right.
Every time you throw something away, the IRS wants you to reconcile your balance sheet, meaning your depreciation schedule. So let's use for this example, a roof as the example. Let's say that you buy a building for the $2.4 million. My engineer is going to break out what part of that $2.4 million belongs to the roof.
Yep.
It's not applicable to what it costs to build a roof or what it costs to replace a roof. It's all baked in. And that's why the engineering part of this is critical. So my engineers will break it out and they'll come up with the value of the roof. And then you have the roof in on your depreciation schedule. It's part of the $2.4 million. Now you put a new roof on, you take and you throw the old one away. Well, the IRS doesn't want two roofs on the depreciation schedule because you built a new roof. They want you to expense, and expensing, everybody's dollar sign should light up in their eyes because expensing is what you want as a building owner.
That's right.
And so now the IRS says that it's actually not an option. The IRS wants you to take off that old roof and write it off. And so part of the value of a cost segregation study is now, Neil, you in the reports I gave you, you know what the roof is all about. The roof is one category. So depending on how much of it you threw away, you don't need me. You can calculate what your dispositions are to write that old roof off when you put a new roof on. And this goes through anything you throw away during the life of the building. You can use a cost seg report, a good one that identify, and we identify everything. I mean, we break it out to
like it's intense.
Like, I don't know how many pages my schedules were with you, but I mean, they're massive. They're page after page after page of everything broken out.
Yep. You're exactly right. All right. Talk to me about houses.
Okay. That's a different study. Now, a house, if I go like for your two buildings, I went to the buildings and I did what a detailed engineering study requires. I saw the buildings, photographed them, documented, measured everything. In a single family home with a basis of 500,000 or less, that's not going to fly. I'm not going to fly to Minnesota. It's not going to be worth it, or send somebody to Minnesota. So what we do is we do an analytical approach. So we've come up with a technique where what we do is we use a modeling technique. And the disadvantage of a modeling technique is it's not meant to replace the detailed engineering because we're not giving you the exact linear feet of countertops. What you're telling the IRS is, okay, we expect in this building at this address and this type of construction, we expect to find this much in 5-year property and this much in 15-year property, but we don't really break it out granularly. So you're going to get the acceleration of the depreciation. And for a single family home, that's pretty powerful, just to accelerate it alone. You don't have to worry about the dispositions because relatively speaking, the disposition angle is pretty small on a $150,000 single family home. So it's really not a lot to lose sleep over. But what you are getting is you're getting an affordably priced report that is based on modeling where you can get your accelerated depreciation. And we can go down. I've never really tested it exactly, but I would throw out the number. If you buy a single family home for $50,000, I can make the numbers work. You'll get value out of paying me my fee and getting accelerated depreciation. It's going to come out great.
Yep. Okay. How about this? For folks who have accumulated single families over the last handful of years, and they've never done a cost seg or accelerated depreciation on their single family portfolio, their houses, do they have an option?
Yeah. Here's the deal. It's not a we can go back. This is a mathematical situation where we have to look at the numbers. So I'm just going to throw this out. We know that we can go back about 15 years to when you acquired the building, because whenever you acquire a building, the depreciation clock starts anew. I don't care if George Washington slept in the building. If somebody bought it in 21, that is new depreciable 2021 depreciation schedules. So bottom line is we can go back about 15 years. The only wrinkle is if we get out of the current year. And so right now we're still in current year if you're on extension of 21, but let's just even use 22 as the current tax year. Forget the extension people. So if you bought the building previous to 22, and you go back 15 years, you can do that. But then there's a little wrinkle because you have to tell the IRS, okay, we were using straight line. Now we're using accelerated, and somebody has to do the math and figure out, okay, how much depreciation did you take? How much new depreciation is Joe going to give us? And then those are called the 481A adjustments. So the great thing about the work we do is we do those adjustments for you. We cannot file the change of accounting method form. Your accountant must do that because we can't sign your tax return. So the accountant's going to have to fill out the form, but we do the heavy lifting. But you can go back 15 years, and a lot of taxpayers and accountants just don't get that we can do look back studies going back 15 years. So
no, you can go back and pull all that together. Certainly if somebody's acquired over the last, 15, but the last handful of years, and go back, pull all those together, pull those together, do an accelerated depreciation, and have a change of accounting methodology, simply 1 or 2 forms, right? 1 or 2 page form, and then take all that in the current, whatever tax year you happen to be in.
Right. Exactly.
Catch that up, accelerate it all and depreciate and not pay taxes today.
Yeah. So a lot of folks out there thinking, oh, the ship has sailed. I bought the building, blah, blah, blah. And
Right.
No. Now, why I say 15 years is because there's some math involved.
Yep.
And what we do is we don't do any work until you engage. So we do this first part at no charge. And what we're doing is we're calculating, okay, how much depreciation did you take? And how much do we estimate we're going to find? And if the math doesn't work, meaning you're going to pay me a fee, and if I can't get you at least 10 times my fee, then I will tell you, don't do it.
Yeah.
You can do it if you want, but I'll tell you, I'll recommend don't do it. It's not worth it. So that building you bought too long ago, the value just wasn't there. And I don't think you're going to get a good value proposition by doing it.
Yeah.
So
how many times have you been to Iowa now?
Too many. No,
for the audience's sake, I've known Joe for, I don't know, 3, 4, 5 years, something like that. And I think you've been here 3, 4, 5 times.
Yeah.
And he's in San Diego. It's his home base. And he
But
always
here's
ends up
story.
in Iowa in February.
Here's a wild story. I was there in probably, I'm guessing March or April.
Yeah.
Okay. And I had another building in Portland. It was 70 degrees in Iowa. When I got to Portland, it was snowing. I'm going, wait a minute, this is crazy.
Yeah, it's really unbelievable, huh?
It was great weather, man. I just happened to hit
Yeah,
it perfectly, man. It rained before, it rained after, but when I was there, it was nice.
We come here in May, it was probably 40 degrees.
Yeah, I know.
You never know what you're gonna get here.
Yeah.
Yeah. Let's do this. I want to move on to the final segment, what I call for impact. Your favorite quote: the starting point of all achievement is desire. Keep this constantly in mind. Weak desire brings weak results, just as a small fire brings a small amount of heat. What about that resonates most with you?
That is so true. I mean, what resonates with me is creating that small amount of fire. Everybody's got to keep creating it. And if you feel that the fire is going out, you got to find a way to keep going, keep making the fire, build it again.
Yeah. What do you think holds most investors back from hitting their personal next level?
Okay. I feel they really have to be, especially in real estate now, I'm talking hands-on, and surround themselves with a team of competent advisors. If they don't know it themselves, which most don't, accountants, like financial planners, tax people, like when you use the qualified money, the intermediaries, is to find good people. I know some really knockout people that are really good, and they will help the investor with everything. So I think that number one is don't assume somebody is going to do the work unless you vetted him and they're good.
Right. Yeah. No, that's sound advice. Outside of real estate, what are you most passionate about?
Oh, this is sick. Pickleball.
Pickleball? I didn't know what answer was going to come. You're pretty excited about that.
I just got hooked on the sport. It's funny because I have a mastermind that they meet in Florida. Yeah. And I just found out that, before they have a group of people that meet before the event starts to have a pickleball tournament. I'm going like, really? Wow. I'm down. Next time I'm there. But actually probably the most passionate about is my relationship with my partner, girlfriend, whatever you want to call her. It's very special. And that's probably the most important and passionate that I am.
Joe, I mean, it sounds like she's in the room or she's watching this.
I know, but I'm going to show her this. Kim's her name. Kiki.
Yeah, there we go. Pickleball. You know what? I hadn't played pickleball since I think high school, which is weird that I would have played pickleball that many years ago, but I got turned on to it. I was at my brother's 40th birthday at his friend's house at the Jersey Shore of all places. Nice section of Jersey Shore. And they literally have pickleball courts, a private club with pickleball courts. It was unbelievable. And so we went out and played. It was a lot of fun.
I brought my paddle down.
Pretty intense.
I brought my paddle down to Cancun. I was on vacation last week. I was thinking like, there's got to be in, not Cancun, in Cozumel. There's got to be. And they had none. Zero pickleball courts. I'm going like, okay, there's something wrong here.
Yeah. What's your favorite way to make an impact in the community?
Oh, I think by always reaching out to everyone, especially for me, my callings with younger people, younger folks, and explaining to them what I'm all about. One of the things that I'm passionate about is I come from the entrepreneurial mode, but I like to express to young folks that, that's not for everybody, and be careful because,
That's right.
There's a lot of pressure and stress of having to kill what you eat every single day. And I can see the value of working for, a company, and it takes a lot, but for me, that wouldn't work because I couldn't do it. So I like reaching out and mentoring young people.
It's not all Facebook, right? It's not all Lambos and private jets, is it?
Oh gosh. I mean, the pressure when you have bills coming up and you're going like, where am I going to get the money? Right. And then you got to figure it out how to be creative to get by until cash flow increases. I mean, again, it's really nice. I had a friend who actually worked for the government and he had a very low paying job, but he stuck it out for whatever 30 years and retired. And my God, he's got his retirement check coming in. He's got all these benefits. And who's right and who's wrong? I don't know. His life looks pretty good right now.
I've always said there's no such thing as right or wrong. There's only what's right or wrong for you.
Yeah. Good point, Neil.
Yeah. Hey, for those folks who want to find you, they want to connect, they want to learn more about this, they want to see if this is a good fit for their particular situation, how can they do that?
You know what? I'll drive everybody to my website, which is U.S. Tax Advisors Group Incorporated. So it's USTAGI.com. And there's a lot of wealth of information on there, and also the contact information. And if you want to get an estimate on a building, there's a part there that you can fill out information on your building, and we'll reply with an estimate and let you know what the fee is and how much you can expect to save in taxes.
Yeah, no, it's perfect. We'll make sure we get the link below in the show notes.
Great.
I appreciate you taking the time to connect on here. Cost segs I remember years ago when I got turned on to it, and it was just like a light bulb. It was like, oh my God, this is absolutely incredible. And the ability to reap significant benefits, especially with bonus depreciation still being around. Yeah. It's very significant.
It is. And you know what, people ask me all the time, well, who shouldn't do cost seg? And I'll make this very short because we're out of time. Everybody should do cost seg if you pay income taxes.
That's right.
There's no reason not to do it. And if you don't pay income taxes, don't call me.
Right. Fair enough.
I don't care.
No. Yeah, exactly.
Okay, Neil.
Thanks for the time, buddy. I appreciate you. Hey, for everybody here at Real Grit, I'm Neil Timmins, reminding you that real estate requires real grit. See you next time. If you like our content and want more, you can access it at realgritpodcast.com. You hear it guest after guest. Instinctively, you already know it. But let me call it out. The most expensive action is inaction. The real estate market is full of opportunities. You just need to uncover them. You can build a business that lasts for years, makes monumental impact in the lives of those that you love. It's not just about business, but about the freedom you get because of it. Have you ever heard the saying, if you want to go fast, go alone? If you want to go far, go together. I believe that partnering is essential. In fact, I partner with hardworking investors all the time. The point is that you can get a lot further with the right partner. Let me say it again, the right partner. If you've ever thought about partnering with anyone, or if you have a partner now, I encourage you to download my free Partner and Profit Guide, which includes the top 5 must-answer questions to evaluate a profitable partnership. You can find it at www.legacyimpactpartners.com. I'll see you in the next episode.